I'd like to invite Ilya Strebulaev giving his first keynote. And it's really my honor and privilege to introduce you, Ilya, who will give a keynote about the valuation of VC-backed companies and predicting venture success. Ilya is the David S. Lobel Professor of Private Equity and Professor of Finance at the Graduate School of Business at Stanford University. He is also the founder and director of Stanford GSB Venture Capital Initiative. He graduated from London Business School with a doctorate in finance. He holds a bachelor and a master in economics from Moscow State University and the New Economic School in Moscow. Ilya is an expert in corporate finance, venture and angel capital, innovation financing, corporate innovation, and financial decision-making. His work has been widely published in leading academic journals, featured also in a variety of media, including the New York Times and Wall Street Journal. His work has been awarded a number of prestigious academic awards, including the first paper prize of the Bradl Award for the best corporate paper published in the Journal of Finance, the Pharma DFA Prize for the best asset pricing paper, and the Trefts Award by the Western Finance Association. Ilya, we are so fortunate to have you here at GVC, and the floor is yours.
Thank you so much. First of all, great pleasure to be here. Thank you for inviting me. I'm very excited that a number of groups around the world are interested in trying to understand better the venture ecosystem. And it's a very difficult, I would say, mysterious question about how to predict venture success. So we've been trying to approach this from various angles. I'm going to talk about this from one specific angle. But prior to that, let me mention briefly what also we are doing at the Venture Capital Initiative at Stanford. In addition to predicting venture success using traditional methods, and that also covers the variables that were mentioned today by the team presentation from TOOM, such as gender, diversity, education, etc. And by the way, I always, when I teach my MBA students venture capital, I always give the statistics of Gottman's and others. And the reality is, so you have to update that Twitter. That Twitter is not based on facts. The facts are that the median length of the VC founder relationship is longer than the median, because average is very difficult to define here. The median marriage in the United States. I'm not sure about the marriage in Germany. Okay. But also trying to use a lot of other methods, trying to understand better predicting venture success and trying to understand better the way that we can measure success. Because in fact, even metrics that define success are very difficult to come up with. Just to give you an example, when we study very early stage, let's say for example, thousands of startups that came out of Stanford University, so many of them are relatively young. Well, we can wait for 10 years, but by that time, first of all, a lot of information will become stale, and also a lot of new startups come along. So how to measure venture success in this case? Typically, what's being done is not the eventual outcome, but the outcome intermediate. What is the intermediate outcome for the venture startups in this environment is the ability to raise funding, or the ability to raise the next round of venture funding at what is called up round valuation, which means that the value is larger than the previous round valuation. Also, the word success by itself is quite subjective, because any startup consists of a number of parties, number of constituents. They are the founders, there are investors, there are employees, and others. And what success for founders does not always equal success for investors. So I've seen many of my former students who started companies, and the investors in those companies did receive quite nice return, but the founders didn't. So do we define the success or not? So in fact, what we're doing at the Venture Capital Initiative is also trying to correlate and find various ways to determine the relationship between various success metrics. Finally, let me mention something else. Over the past 3 to 4 years, we've been very interested in another part of the venture ecosystem, about which I'm not going to talk today, but I think is increasing in the world and deserves much more attention. And especially because at the very start of today's event, there was a discussion about why the US is so much ahead and Europe isn't. There are many reasons behind that. In fact, I have a number of papers on that. But one potential reason why Europe can be ahead in the future relative to the Europe of the past is corporate venture. If you look at the United States, then corporate venture, which means basically the venture funds that are invested on behalf of large corporate parents most of the time, either public mostly, but also private companies. In the United States, in 2020-2021, more than 35% of all the venture deals included at least one corporate venture fund. And if we look at Europe and Asia, then I think corporate venture is becoming even more important. The reason being is that the traditional venture funds are not that important, especially in Europe. And as a result of that, we did a very substantial study on American corporate venture funds. And we studied the design, the micro elements of design of over 100 corporate venture funds, and found that, well, many of them are not designed properly. And I think that would be great to have similar study on the European, including German, corporate venture funds, because I think that in turn will also lead to the not just predicting venture success, but also having an impact on how ventures in various countries may succeed. Okay, enough about preliminary stuff. So this is going to be based on a research project with my former student, Will Gornell, who is now a professor at the University of British Columbia. Several years ago, Will and I developed a framework to value venture capital-backed companies. And valuing venture capital-backed companies, and when I say VC-backed companies, I mean companies backed by venture capital at the time when they're still private, is very important for a number of reasons, and again, for a number of agents in the venture ecosystem. For example, valuations are critically important for fund managers to select management team, critically important for limited partners to select fund managers. In the recent years, secondary markets liquidity is on the up. And obviously, without valuations, the secondary market is not going to become more liquid. I work a lot with family offices around the world and sovereign wealth funds about the allocation of their funds to venture capital and private equity ecosystems, and also about the decision how to allocate funds to specific fund managers. And valuations, again, are critical there. Not the final evaluations when the companies go public, for example, or get acquired, but intermediate valuations of venture capital-backed companies. The valuation is very difficult in the venture capital environment for a number of reasons. One is generic because it's more difficult to value private companies compared to public companies. But even on top of that, there is an additional challenge. And that additional challenge originally is a feature of the Anglo-Saxon law, but I believe that is the same in continental Europe, including Germany. It's not just because it's difficult to predict cash flows. Well, many startups, I'm sure coming out of TUM as well, have no cash flows, have just hope for future cash flows at some point in the future, and lack of information. But in fact, a much bigger reason is an extremely complicated, convoluted nature of what we call in academic finance capital structure, and what typically practitioners call waterfall provisions or financial structure of companies. At least in the United States, and I believe also broadly in other countries, and also many European and Asian startups are incorporated in Delaware anyway, because investors require them to do so. In the United States, the traditional financial structure that is used by public companies, for example, let's say consider IBM or Microsoft, they will have one type of common share, they will have no preferred shares, and of course they will have a lot of debt issued. That's typical structure. Here we have a structure where there's typically going to be one or more issues of common shares that is typically held by founders and the management team and then rank and file employees. But then we have many classes of preferred shares. Each venture investor in subsequent rounds of fundraising will be having a different type of preferred shares. And also, for those of you who are experts in public financial markets, the word preferred share means something, And as I tell my MBA students who are experts in this, because they had to pass, to come to me, they had to pass the traditional finance at Stanford. Whatever you've learned about preferred shares in traditional finance, Finance 101, forget almost all of this. Because preferred shares used by venture capitalists are not preferred shares in traditional financial markets. And so, because on average, these venture capital-backed companies raise 5 to 6 rounds, in our data set of about 50,000 venture capital-backed companies in the United States, the maximum number of rounds, I believe, is over 50. The median is 2.5, but that's relatively low, but that's because most of those companies are unsuccessful and fail pretty quickly. If you look at unicorns already mentioned today, then the average number of rounds is going to be 6.5. And in fact, the eventual number will be higher because many of those unicorns are still private. And each round gives those investors very different cash flow rights, corporate governance rights, control rights. So this all makes very different to value those startups. So Will and I, back in 2016, developed a valuation framework that we used to value every single American unicorn at the time. So unicorn is a privately owned venture capital-backed company with a reported valuation of $1 billion. And notice that I stress the word reported valuation because whenever you read in the newspapers that yet another startup raised money at $5 billion valuation, this is not valuation. This is not the market value. And of course, most people, I talk to so many journalists, but also limited partners, pension funds in the United States, they confuse the reported valuation with the actual valuation. The valuation used in the startup world is called post-money valuation. And it's a particular function, particular formula. I'm going to introduce this later. But post-money valuation is not the implied market valuation of a company. And so we developed a method that allowed to estimate the fair value of the company when we have the post-money valuation. And applied it, as I already mentioned, to all the unicorns. We found that on average, American unicorns at the time were overvalued. When I use overvalued, meaning that their reported post-money valuations were higher than the implied fair values by about 50%. And so that was big news at the time. So it was the only time in my life so far when I was featured on the front page of New York Times. And suddenly my phone, nobody cared about my phone before, but suddenly everybody tried to call me. And also I was not the most popular person in Silicon Valley on that day. And that also led us to predicting success, because we could check whether the degree of that overvaluation had any relationship with the eventual success of unicorns. Okay. So that original valuation framework had one challenge. One challenge was that we assumed in our valuation framework that there was only one round of investment. And that was for technical challenges. The model was quite complicated. And therefore we applied it only to unicorns, because unicorns are kind of by construction are late stage companies. And even if they have more rounds of funding, that is going to be relatively unimportant. So since then we extended this approach. And this is a new valuation model, which encompasses the previous valuation framework, that allows for multiple rounds of funding. And now we can apply this, and I'm going to apply this to about 40,000 deals, about 15,000 companies. So here is a quick example of a company that all of us heard of, WeWork. And what is really interesting here is WeWork, kind of the share price went up, went down. Now, you see all those dots. Those are reported prices by mutual funds. Because WeWork very quickly became quite highly valued, many mutual funds decided to invest in WeWork directly, bypassing venture capital funds. And mutual funds have to provide quarterly reports. Now, if two mutual funds own a common share of IBM, then presumably the price reported by those two different mutual funds, okay, on the same date will be the same. Well, that is not the case here. And as you can see, there's a dramatic difference sometimes. So, like, for example, at some point in 2018, the difference was more than 3 times. And that is the same share, the same type of shares, held by 2 different mutual funds. And that is because, really, nobody knows how to value those companies. So that's just one example of the challenges we face in evaluating those companies. So here is, I will not go into technical details. If you're interested, of course, you can, the paper is, both the original one and the updated one, the revised framework is available with all the fancy equations. I will not show you any equations, but I will try to show you the feeling for what is accomplished and why it's important, and at the same time why it's kind of challenging to do. So here's an example. I'll give you an example of SpaceX, which I love giving for a number of reasons. One, of course, it's a well-known company and everybody talks about SpaceX and its founder. Second, luckily for me, it's still private. And right now, I believe, is on round R. A, B, C, D, R, okay? And I pray every single year when I teach MBA students that SpaceX is still going to be private, because that's my favorite company to give to MBA students, because it covers everything that I would like to cover. So here is one issue. So SpaceX raised its first round of funding in 2005. It was founded in 2004, 2005, and then 2008. Now, common shares was held by the founders and early stage employees. And then it raised Series A from venture capitalists, and then it raised Series B from another group of venture capitalists. Now, what's shown here is on the vertical line, Series B payout. So this is the payoff of Series B preferred shares, those that are held by venture capitalists that invested in round B. And on the horizontal line shows the exit value, meaning that, let's say, SpaceX would be sold for $250 or $100 million. And again, this is when SpaceX was still a very young company, and therefore those hundreds of millions of dollars was still a substantial amount of money, okay, for SpaceX. There's something else. If you look at the description of the vertical line, it says M&A payout. It turns out that for many, in fact for most, venture capital-backed companies, the nature of their contracts is such that the payout is different. Whether the exit is going to be M&A, so the company is acquired, or the company goes public. So therefore, unlike for most other companies, the payoff structure should be conditional on the type of the exit. So this is just an example for a particular type of an exit. What we show here is what any of you who ever passed a derivatives class would immediately recognize as some kind of an option. If the outcome is relatively unsuccessful, then this red is common shares. Then common shares will get absolutely nothing. And then effectively Musk will get absolutely nothing, okay, at the time. And then if the company is becoming pretty successful, then the common shareholders will benefit more and more. The green line is Series A. And what you see here is that if the company is very successful, then the payoff is going to be the same, whether you're a common shareholder or a venture capital investor Series A. But if the company is relatively unsuccessful, then the payoff is going to be very, very, very different. And prior to our paper with Will, original paper from 2016, there was really no way to distinguish those two. And here is Series B. So Series B was issued in 2008, financial crisis, and got very preferential rights, not only relative to common shareholders, but also relative to Series A. So this is an example that, in fact, different venture capital investors in the same company are treated very differently. Specifically, if the company would be relatively unsuccessful, Series B will get much more. Common shareholders will get nothing, but Series B will get much more than Series A. And if the company is very successful, then there will be no difference. That is the overall feature of the venture capital-backed companies. If the companies are truly super successful, then kind of there is no difference. Then we will all get the same per one share. But there's something else. So now I'm going to concentrate on Series B, because SpaceX, as I told you already, issued Series C, D, E, F. What happens is that the payoff of Series B, shown here after Series B, that I showed you on the previous slide, changed. Because every single time SpaceX issued another round of funding, the payoff of the original securities changed. That is because the new investors coming in negotiated some additional rights. Sometimes the change is relatively immaterial, so that is the payoff of the same Series B, but after Series C was issued, so the next round of funding. And that is after Series D. Now that is interesting because Series D negotiated something else. Series D negotiated seniority, which is unless they're going to be paid off, nobody's going to get anything. Which means that, okay, there's no laser here, but if you look at, actually maybe there is, no. But if you look at the bottom left, you see that, thank you, you see that when the values are like below 50 million, then Series B will get nothing. That is because all the payoff is going to go only to Series D. And then, I think now you have to give me back the right to click. So this is after Series E, and this is after Series F. Now, after Series F, what's happening is that Series B is all at the coincides with the horizontal line. So in fact, even if SpaceX is sold at $250 million, at $500 million, Series B still will get absolutely nothing. That feature is critically important, as you can see, was not taken into account in our original valuation framework. And therefore, our original valuation framework really, at least theoretically, is not correct to apply to early stage companies. But we wanted to do it. And so we addressed this. So here is a visual description of how our model works, without any equation. It is based on the traditional option pricing framework. I'm sure that all of you are familiar with the Black-Scholes framework, which is substantially modified here to match the case. But the idea is the following. We start with knowing the initial financial structure. So let's say we would like to value SpaceX at the time of Series B round. We assume that we know the initial financial structure, and empirical data we will know. We will know the almost complete financial structure of about 40,000 deals for about 15,000 companies. And then what we're going to assume is there is the value process, and we're going to assume that at some point there could be an exit at some random value, which is going to be determined by the log normal Brownian motion process. And that isn't really our original option framework, which had a very high chance of predicting the eventual outcomes. The updated framework is that there still could be an exit. By the way, exit could be IPO, M&A, but also failure, bankruptcy. But with some probability, there's also going to be another round of investment. And there will be random terms, because the next investor, Series C, Series D, and so on, will demand some additional terms. And they're going to be determined based on the empirical specification, based on the data that we have. And then this continues. And theoretically, the company might raise infinite number of rounds, and that's more or less what we're approaching with SpaceX. But obviously, at some point, all companies will exit in the model. Okay? So behind this is 3 years of hard work. So if you're interested, please look at the appendix. And so let me show you the results. First of all, the data. We use, at the Venture Capital Initiative, a combination of data sources. We start with the two commercially available data sets, the PitchBook and VentureSource, that we merge, because PitchBook is much better since around 2014, 2013, and VentureSource is much better prior to that. And then for most of the companies, we also have contractual data, which is in the COIs, Certificate of Incorporation of those companies. And we process those manually most of the time, and we complement it as much as we can. And for many companies, we also, especially for highly valued companies or for better known companies, we manually fill some additional data. We apply our model for all the companies that raised venture capital rounds in the United States between 2005 and 2020. And that's about 40,000 rounds. And what is going to be here is the overvaluation. Let me introduce what I mean exactly by overvaluation. I mentioned post-money valuation. Post-money valuation is very simple. It's a product of two terms, which is the price of the most recent round. For example, SpaceX Series B will be the price of Series B. SpaceX Series R is going to be the price that venture capitalists paid for the Series R preferred shares. So that is the first term. The second term is the total number of fully diluted shares. What is fully diluted shares? Well, we have common shares, but also we have all the other shares, such as preferred shares, that could be converted into common shares. So all those preferred shares, A, B, C, R of SpaceX, could be, and in a very successful outcome, will be converted into preferred shares. Okay? So that is fully diluted shares. Not only preferred, but any instrument of any kind, for example, let's say employee stock options, warrants, and so on, that could be converted or could lead to those investments getting additional common shares. That will be the base of the total number of fully diluted shares. And so post-money valuation is the product of those two terms. Intuitively, it will almost always lead to the overvaluation. Why? Because based on the payoffs I showed you, in SpaceX, for example, preferred shares are always provide either the same payoff as common shares when the company is doing very well, or a higher payoff. So therefore, preferred shares are always, by definition, by construction, are always worth more. So prior to our paper with Will, nobody really was taking this into account. Like those mutual funds, they had common shares, but they priced them at the price of the previous round, or the most recent round, which is they really thought that their common share is valued as much as the preferred share, which of course is not the case. And so overvaluation is the degree by which post-money valuation is higher in percentage terms compared to the model implied fair value of the company or the debt security. And so if we ignore all the terms, by the term I mean contractual terms, such as preferred share, for example, there will be no overvaluation. And this is if this is the original model. So this is the original model of Ilya Strebulaev when we have only one round. And this is the updated model. There are a couple of interesting comments here. First is that the overall degree of overvaluation is extremely high, whatever model you use, between 50 and 75%. That is on average. There are some extreme cases where overvaluation is like 1,000%. But this is very, very high. So in fact, using post-money valuation as an indicator of the fair value is not a good thing. If you're an employee, especially, if you're an employee of a Silicon Valley-based startup, using the post-money valuation is a bad thing. Why? Because as an employee, typically you have options on common stock, which are much more affected by overvaluation than any other security. And so if you think that your common share is worth $10 because it's based on the price of the recent round, based on this, it's maybe $5, $4, or $3, or even less. Second is that, as you see, there's a secular decline of overvaluation from about 75% to around 50% over the past 15 years. That is an interesting story here behind that, likely because there is a substantial increase in the competitive environment, especially in Silicon Valley. About 60% of data here is from Silicon Valley, just because that's where most US startups are based. There's a substantial increase in competitive environment, which makes contractual terms more founder-friendly over time. So that's likely what's happening here. And third, interesting enough, what we found is that for an average case, or for a median case, ignoring future rounds is not that important. So here is my empirical, practical implication. If you know the contractual terms of your startup, let's say you're a founder or an employee, and it is a standard contract, so that your preferred share investors do not get any super rights, such as seniority, which I showed you in SpaceX. then in fact ignoring future rounds is okay, implying our original model is much easier. It's really straightforward. However, the moment you have some unusual features, seniorities, multiple liquidation preferences, IPO ratios, and so on, then in fact the difference is substantially larger. That's in fact shown here on the next slide. Those are some examples of features such as high liquidation multiple and AD. AD is anti-dilution. And we show that if we ignore, for example, the case of high liquidation multiple, then could be a dramatic overvaluation. Okay, let me skip that. This is the final slide before I address the topic of today's conference. What we found, which is I found very interesting, and we really found this from the data that kind of nobody looked at before, which I find the most interesting here. So what's happening here? We'll look at the price differential between the rounds. Again, think about SpaceX Series D round versus Series C round, okay? And that is the change in the prices of preferred shares between the rounds. And again, this is about 42,000, I believe, rounds. So to the right of 0%, those are up rounds, when the next round, the preferred share price is above the previous preferred round. To the left are what is called down rounds. And a plus 25% and a minus 25% are effectively, those extreme cases are 25% and above, or minus 25% and below. And you have kind of some not exactly uniform, but some kind of distribution. However, do you see the 0% spike? That is the case where the next round price is exactly the same as this round price. In public markets, that will be very unusual. How often do you have the case that the IBM price today is exactly the same as the IBM price 2 years ago? That is called flat rounds in the industry jargon, and they are extremely prevalent. There's about 20, I believe 22%, but over 20% of flat rounds in our data. And the question is, why do we have so many flat rounds? And here is one potential explanation. So that is the topic for another research project I'm involved in right now. But flat rounds are driven likely, or that's our conjecture, by the contractual terms. There are many contractual terms in this data, in the VC-backed contracts, that are contingent on what's happening with the company. And most of them are contingent on whether the round is an up round or a down round. Down rounds might lead to dramatic changes in the capital structure of the company. Founders might be wiped out. When I say founders, common shares. But also previous preferred shares might be wiped out. And therefore, negotiating the flat round when the price is the same effectively avoids the complete financial restructuring of the company. But if that is the case, that means that in fact, those flat rounds are hidden down rounds. And therefore, if that is the case, then this will predict the eventual outcomes. The prediction is that if you look at the flat rounds, because they're actually down rounds, very often there's going to be a discontinuity between the eventual outcomes for those companies compared to the companies that are close to them. Okay, and that's what our preliminary results, in fact, suggest. But that is one of those things where I love empirical research, because we didn't expect that. At least at this level. Okay, so what I promised to Isabel is talk about the predicted venture success. And in our original 2016 paper, we checked whether overvaluation of unicorns lead to any predictability. Well, we had only 135 unicorns, and most of them were private. So therefore, our data were interesting, but statistically not significant. Well, here we have a very statistically significant result, and as I will show in a second, very economically significant result too. The idea is the same. It's just that we have now 15,000 companies, and many of them already exited. So what we're doing here, we have the independent variables is going to be, the main one is going to be overvaluation that I already introduced. Again, that is the effective difference between the reported valuation and the fair value. And the higher overvaluation really means is that there are some kind of contractual terms that the new investors negotiated, meaning the new investors had the bargaining power for whatever reason that the founders, the common shareholders, and the original existing investors, inside investors, didn't have. Okay? And the intuitive idea is that, well, when the new investors have a lot of bargaining power, when the company is not doing well, for example. Okay? So the original idea is that the overvaluation can predict success. And this starts from the second round. For the first round, we excluded here the very first rounds, like Series A. But this data includes all the subsequent rounds. So therefore, even if you have very early stage companies, but that are already, of course, raised venture capital money, then you can compare the overvaluation and also the relationship of the next round to the previous round, and this is what we find. So we control also for PMV. PMV is the post-money valuation, and that is because there is a size effect. Okay? And we also control for the various fixed effects, including the investment year fixed effect. And here we have all the companies that raised at least 2 rounds and already exited. Okay? In the first 3 columns, all that raised another round in the last column. And so that's a lot of observations, at least compared to 135 unicorns that we had originally. What do we find? We find an extremely statistically and economically significant negative effect on the overvaluation. Let me introduce the variables that we're interested, the outcome variables that we're interested in. Starting from the left, the first one is the exit over PMV. Exit value, which is at what price the company exited. Failed companies exited 0. There's IPO value, or there's the M&A value, divided by the post-money valuation at this round. So effectively, how the company performed relative to its post-money valuation today. The second is the dummy variable that is often used in venture capital research, and it was always used prior in the past when the valuation data wasn't available, whether the company goes public or not. Because we know that most companies that are very successful go public. The third is similar, but then we also include M&A above a certain value threshold, because especially in recent years that our data set covers, a lot of successful companies did exit through the M&A. And the final column is the price change, meaning that in the first 3 columns we look only at the companies that exited, so they left the venture capital universe. But in the last column we looked at the price change, like SpaceX, for example, will be in our data from Series C to Series D and so on. Okay? So we find that in all 4 specifications, we actually have 8 specifications, I'm not going to introduce the other 4, but in all the specifications, the overvaluation is extremely significant and enters always negatively. When I say extremely significant, in fact, the R squared is very high. If we whoever knows about the pharma French research or trying to predict the factors, stock returns and so on, the R squares are pretty high here. So, and we really rely only on the overvaluation variable here, overvaluation factor really here. Everything else is just for robustness. Now, how economically significant these results are? So let's think about IPO. This is log, so therefore it needs to be interpreted, but minus 1.11 approximately means the following, is that if you have a round and it's overvalued by more than 20% relative to the benchmark in that investment year, because everything should be interpreted relative to the investment year. So compared to other firms that raise venture capital rounds in that year, then the probability of your IPO goes down by about 5%. Again, relative to that investment year. That is a very significant effect. So using overvaluation, or effectively using the contractual terms that those companies use relative to the contractual terms used by other companies within the same period, can lead to a very substantial ability to predict outcomes. Now, one caveat here. This is a fascinating research. Well, I'm biased here, of course, okay, but I believe so. But that is complementary to what Isabel and her team were talking about at the very beginning, because they talk mostly about the very, very early stage, like what we call in the very pre-seed stage, where there is really no valuation. This is purely financial data. We don't look here at the management team and so on and so forth, but that is, I'm not saying that one should not look into the management team here, but that is hard data, even though it requires a lot of interpretation, some assumptions. But we have a lot of data here. This is the stage of the companies where companies did raise one or more rounds of venture capital funding. Okay? And yet, I think this is the first result. I'm unaware of other results that explain the effect of contractual terms and valuation on the eventual outcomes. Another interesting thought that I have, as I was listening to Isabel and her team, is that this is the US data. So we have, I have the contractual data on the UK companies as well. We didn't use it yet. I don't really have the data on German or other European venture capital-backed companies, but I would be interested because once you have the contractual data, just having the valuation data isn't sufficient. You really need to have contractual data on those companies. But once you have it, you can apply the same method. Once you know how the payoffs are going to be allocated in various states of the world. And I'm very curious. My conjecture, of course, is that, well, the US is not really an exception, so it's going to be similar. But I don't know. So this would be interesting to study. And to conclude, if I just have a couple of more minutes, to conclude, we've done something else that I would like to mention, which is very interesting. And I'm going to tell you that when I present this, research a lot to practitioners, for example, mutual funds, pension funds, sovereign wealth funds, family offices investing in venture capital space. They're very interested in this slide. Academics typically less interested. Okay, so what's happening here? What kind of values are reported in the data? Well, I already mentioned mutual fund values. I mentioned when if you remember the very beginning of my talk, I gave you an example of WeWork. Another one, and so here they are. So what's happening here, it's pretty complicated, but on the vertical slide, we have the observed prices as % of the new round price. On the horizontal, we have the model implied prices. And if our model matches the prices, then it's kind of going to be on the 45% line. Well, the mutual fund values they are the bluish, and as you see, they are kind of fixed. They're almost all of them are 100%. So basically, mutual funds just take the most recent price, and even though most of them own common shares, for the reasons I will not go into, they disregard it. Sometimes, as you see, there's blue stuff. Sometimes you see the 80%. Like there's another horizontal crosses over there. That's because many mutual funds, what they do is that they take recent price and then apply a 20% liquidity discount, because that's what they recommended by their advisors, because those are private companies. The triangles are the so-called 409A values. 409A values are the values that companies must report for the tax purposes. This is the IRS value. And the IRS values, as you see, are way below our model, dramatically, sometimes at 0. So the tax valuations have nothing to do with, well, I say with reality. Of course, correct way to say with our model. Okay. I'll have my final slide on the tax valuations. And finally, the green ones is something that we're still collecting data on. As I mentioned at the very beginning, the venture capital industry is undergoing one substantial change. There's an increase in secondary market liquidity. And those are the secondary prices provided by one anonymous source to us. And those are, in fact, the closest to our model implied values. but we have just basically 20 data points, so that's not very interesting at this point. But we're in the process of getting, hopefully, thousands of data points, which are actual trades, the effective trades in the secondary market. Most of those trades are by the former and current employees of successful or relatively successful venture capital-backed companies and new investors, those who would like to get those shares at the pre-IPO stage. The tax valuation. So this generated a lot of controversy. And this is going to be my final slide. If you're in the US, that's kind of important. So those are my quotations. So companies must hire an independent accountant, an independent advisor, licensed, certified, to do the tax valuation. And again, that matters for the companies because the tax implications for the company and for the employees especially are critical. And you would like to reduce the share. You would like to tell the IRS, ideally, that the stock price is worth 0. Then there will be no tax implications, okay? So this is taken from the websites of those companies, okay? Their strike price must never be below the current value of your common stock. The strike price, that's because employees get options with the strike prices. Okay, but there are still ways to legally lower your strike price by getting the valuation of your common stock down. That is on the official website of this company, ShareWorks by Morgan Stanley. And this is a MEL evaluation. What we aim for in 498 is to try and get you the lowest possible answer that is still defensible against an IRS audit, okay? So that is very cool, and that's obviously suggests why the tax valuations are so different from the model implied valuations. So let me conclude. First, if you are interested, I advise you to go to online and try to find either the original paper that has 135 unicorns in the original theoretical framework, or the revised paper, the new paper. Both of them are available on SSRN, Social Science Research Network, ssrn.com. And this has the updated, or really completely revised theoretical framework, but also tens of thousands of empirical observations. And I think the conclusion is, first, contractual terms matter greatly. And again, I would like to see more research outside the US context. Second is that for at least companies that did raise venture capital funding, there are hard ways, hard meaning hard data ways, to predict success in a very statistically and economically significant ways. And in fact, investors do use those methods these days. Thanks so much. And I'll welcome any questions as well.
Thank you. Thank you, Ilya. Fascinating research. We exchanged glances saying, oh, maybe we can give you the German data and we can check if it holds true. We're collecting that kind of data. Yeah, questions from the audience? Yes.
Thanks a lot. Thanks a lot for the presentation. Oh yeah, that's fine. My question is about the true value you've mentioned in the model. I mean, you've mentioned that the overvaluation is quite high, but how did you get to the true value?
Yeah, so let me tell you the idea. And the idea is very similar to the Black-Scholes option pricing framework. So in the Black-Scholes option pricing framework, we have the stock price. Let's think about IBM stock price, which is publicly traded, and the option on the IBM stock price. And in Black-Scholes option pricing framework, you take the IBM stock price, you take the interest rates, and you get the option price, okay? So that is how the world of derivatives works. And trillions and trillions of Black-Scholes models are run every single day by investment banks, traders, and so on. Okay, what you can do is you can reverse. What you can do is, if you know the option price, for example, in Chicago, options are traded on the Chicago Board of Trade. So if you take the option prices, then in fact you can back out the IBM stock price. Now people don't do it because there is no need to do it, but in fact you can do it. So this is what we did. In our original framework, what we did is, if you know the capital structure of a venture capital-backed company, then every single security is an option, or really a derivative. Like I showed you the payoff structure of SpaceX, that is some kind of derivative. Not all of them are simple call options. In fact, they could be very, very complicated. But all of them are derivatives, okay? Which means is the following. If you know the capital structure, and if you know the price of at least one security, then you can back out everything else. You can back out using the revised option pricing framework specifically adapted for the venture capital setting. You can back out the price of all the other securities and also the implied value of the company as well. Now, what are the prices that we know? Well, at each round of investment, the new investors come in. And let's say, going back to SpaceX. So Series D investors came in, and they said, we're going to buy SpaceX at $25 a share. $25 Series D preferred share, right? If there were Series D preferred investors. We take this as given, because those are new investors. They negotiate the contractual terms. But at the end of the day, those are that they're prepared to pay. Okay? So Series D sometimes might be valued more than $25, but they cannot be valued less than $25, because then investors would not invest. At least that is their perception. So we take this perception as given. From this and from the capital structure, that's why contracts are critically important. We can back out everything else. Okay? So that's how this is done.
I see. Perfect. Thank you very much, Ilya. Very interesting talk. I mean, the differences you've pointed out in valuations are massive. Have you seen any time effects? Has it changed? Has it decreased over time? First question. And second question, were there any external effects from the policy that trying to decrease those overvaluations that you've pointed out?
Mm-hmm. So over time, if we can still move the slides, about slide number 7, I believe, or 8, then in fact we will have the results. Okay. Yeah, slide 7. So if we see then the next one, this slide just another click and another click and another click. Thank you. Let's go back. Okay. So that is the secular change in overvaluation over time. Okay. So it did decline over the past 15 years. So that's what we found. And again, likely we in fact did not study this carefully in detail, but the only explanation I can think of is the change in the contractual terms over time because of the environment in the United States. Because there's more competition, more supply of money by venture funds and other investors, and as a result there's more competition among investors, so the terms are becoming more founder-friendly. When terms becoming more founder-friendly, the overvaluation decreases. Is there a way to check it? Well, very soon we will be able to check it, because if we go into hard recession over the next year, then in fact the overvaluation, my prediction would be that the overvaluation will actually go up. But we'll find out. What this slide doesn't show, though, is dramatic cross-sectional variation. So that there are some almost 99.9% of our cases, there is some degree of overvaluation. Sometimes it's very minor. And then there are cases of 1,000% overvaluation. From the point of view of policy, it's not about overvaluation, it's about contractual terms. And in the Anglo-Saxon law, there are 2 ways that this could be changed. One, because it's the rule of legal precedent. The first is various securities regulation acts. I personally would advise against that, because that constrains the abilities of parties to negotiate. Every single contractual term is done for a purpose. And when you try to tell the parties that you cannot use that specific contractual term, well, one solution will be that the investors just will walk away. So in fact, it's endogenous, meaning that the equilibrium outcome might be worse. The second is the legal precedent. Just to give you an example, about 5 or now it's already 7 years ago, there was a fundamental change in Delaware, where most of those companies are incorporated, where the Delaware Chancery Court, in one of its decisions, decided against the preferred shareholders on the board, acting on behalf of preferred shareholders. So that is, I forgot the name of the case, but it's the case name, but it's a monumental shift, because in the past, the preferred shareholders on the board, as a board member, you have fiduciary duty to the company, but as a representative of the venture capital fund, you really care only about your preferred shares, which of course leads to conflicts of interest. So in the past, when you had to make a very tough decision, for example, to, let's say, sell the company, close down the company, then many board members were acting on behalf of the venture capital funds or the preferred shareholders. So the Delaware court kind of effectively struck that. So that led to effectively to changes in the contractual environment. And every single year, some minor shifts happen. That is the nature of the Anglo-Saxon law. It's mostly driven by the courts. Okay. There's another question over here.
Last question. One last question is after that.
Thank you for the great presentation. It's the valuation from the perspective of the venture capital firm, mainly. What's the application for the startups? Is there a way that they can, for example, structure their funding to maximize it for the future rounds and prevent sacrificing the current investment?
So one correction, this is not the valuation from the point of the venture capital funds. This is just the valuation. The valuation is the same whether you are, the valuation of the venture capital-backed company is the same whether you're a venture capital investor in the company, whether the founder or the employee. Now, of course, if you're an employee, you hold different shares, and therefore the value of your shares will be different likely from the values held by of shares held by venture capitalists. But the valuation of the company is the same. The method is exactly the same. Are there any implications? There are many implications. Go to our paper. We actually have a section about the implications about founder-friendly, I just didn't have time to discuss today, about founder-friendly versus founder-unfriendly terms. In Silicon Valley, very often the jargon is founder-friendly or investor-friendly terms are used. And our model allows to specify exactly what is founder-friendly, founder-unfriendly or investor-friendly, and how founders might want to think about those, because we have rough quantitative implications, so that very often, even if you don't know the exact contractual structure, even if you know the contractual structure, but you don't have ability to execute on this model, you in fact can approximate what's going to happen with your company. For example, if you're a founder, let's say, and the investor demanding the so-called super anti-dilution rights or super multiple liquidation preference, you really don't need to have this model. What you can do is a couple of scenarios. Like if the company goes sold at this price or at that price, and our model will tell you more or less, all things equal, of course, what are going to be the quantitative implications for you. When I say for you, for the hold of common shares or for the hold of options on common shares. Okay?
Thank you.